This is House Planning Help episode 358. Hello, I'm Ben Adam Smith, and this is the podcast for you if you're interested in self-build or retrofit. I'm exploring what houses we should be building in the 21st century and trying to break down the major roadblocks that may get in our way. Coming up in this session, my guest is Tom McSherry from BuildStore, and we're going to be exploring the ins and outs of borrowing money for a house build. So this is certainly a topic that might scare you. Perhaps you've seen a TV show where they ran out of money and it all ended in disaster. But I did, before we get going, wanted to reassure you of a couple of things. The first of which is you don't see it very often, not on a dramatic scale. Perhaps there's a petering out as people get towards the end of the project and maybe they'll close a door and think, yeah, that can wait. So there's a bit of that goes on. But largely, most people, the vast majority of people get to move into their properties. And then what you quickly discover is they finish them off. They're back at work. They've got more money just to do those final few things. And then the second point was that if you engage a company like BuildStore, then I think there's even less chance of things running away because they deal in the business of risk. And so, of course, everything is thoroughly tested for risk. And that's part of the process. They don't want you to run out of money. No, that would be a disaster for them too. So it's all about accurate costings. That's probably something that every single project should have, but sometimes it doesn't for one reason or another. And then when I think back to the projects I do know that have run out of money, I wonder if they've been forced into this to have a look at mortgages at the beginning, whether one of two things would have happened. Either the mortgage company would have just said, nope, we're not going to support your project. We think you're mad, or come back to us when you've scaled down your ideas. So let's get into our interview today. I started by asking Tom to introduce himself and tell me a little bit about his background.
Tom McSherry, National Business Development Manager at the BuildStore. Over 30 years in financial services, Ben, and 19 of those working exclusively with BuildStore. Background many years ago was engineering, actually in brickwork, so in the construction sector. And I suppose got a bit of a passion for it, having renovated the family homes and subsequently then gone on to buy a plot a number of years ago and commissioning the design of our current family home. And I hasten to add, not self-build our family home, because self-build, I suppose, in many instances is a complete misnomer. Most of us, like I did, get involved with professionals who can enhance the design process and, of course, do the difficult part, constructing the property, where my skill set lay was more managing a journey and ensuring that the finance worked fluently.
Yeah, we've all got to know our strengths, haven't we? And I always think even for those people that do have lots of practical skills, it's still a team situation. It's not something you want to be doing entirely by yourself or you'll be there forever.
Absolutely. And BuildStore have funded over 30,000 projects in the UK over the last 25 years. So real experience and relevant data. And David Snell, who writes many of the great books in the sector, I always remember David pointing out to me very early in the process that if you think you're going to be cutting about in a suit Monday to Friday and putting roof tiles up on a Saturday and Sunday, you'll be in accident and emergency on the Monday because you're not used to doing it. And I think self-build's a spectrum, which starts from the DIY enthusiast who perhaps does have relevant skills to bring to a project. And of course, what that can do is provide savings, all the way to a fixed price contract where you have little or no input. You could go off on a holiday and come back to a finished house. But the vast majority of clients will adopt a project management, a package solution, or perhaps get involved in the project management side themselves.
Now, so often when we chat to people, they say, oh, bring us in on day one. So I'm quite interested to know your perspective here on what is day one. Is day one just dreaming? One day I'd really like to build a house, or is it more, I'm thinking of buying this plot of land, or is it actually I've bought this plot of land, or is it even I've got designs, I've got planning permission? Where is a good time, or maybe several times we can chat to you?
Yeah, I mean, our incubation period with customers could be anything from 3 to 4 years. We have a team who specifically look after early engagers who perhaps have a dream to do this, set themselves targets and goals to do this, not quite sure how to. But the ones who really have looked into and researched what that journey should look like should always start with the budget. Because unless they've got a clear understanding of their budget, the reality is they're not quite sure how much they could afford to pay for land, and having bought a plot of land, not quite sure how much they've got to build a house. I think early engagement is really, really important. The further they are up the river, to allow us to do some real planning and support for them around their budget can be really helpful. That's not to say that we don't have a lot of customers who turn up with a set of plans and detailed drawings and need funds in the next 3 months to start a building project. Many of them, of course, that works out absolutely fine. Some, of course, will have to do some adjustments because they may find that the plans that they've designed are out with the budget when it comes to actually costing it. So, and right up to clients who perhaps are already partway through construction, approaching the end of construction, and simply need some funds to get them over the finish line. So we have experience in dealing with all of those scenarios. To avoid the grand designs problems, of course, the early engagement and setting that budget to help architects, designers, package solution providers, all of them to work within a budget, I think is really important.
Maybe we can come back to this question then of how much we really should be borrowing, because I think it makes sense to just understand some of the process that's going on here. So can we just start with, we're buying a house, we need a standard house purchase mortgage. I don't even know, do you do that product?
Yeah, very much so. I mean, at the heart of BuildStore is we are an independent mortgage broker, whilst we have a large specialisation in certain arenas. And often that will be our clients who are finishing a project. We look after them for their normal standard residential and remortgage needs. For that scenario, it's definitely far less complicated because the responsibility is to get the right loan amount to allow in the purchase of the property. We would complete a regulated fact find to get a full understanding of the client's circumstances and their affordability and what their objectives are in terms of the type of interest rates that may be of interest to them. So it may be controlling costs through fixed rates. Some higher rate taxpayers may be looking to offset mortgages or trackers discounts. It's the type of interest rate that the clients will be discussing with. The loan amount needs to be correct, minimising fees. There are some excellent systems that mortgage brokers use that then allow them to do a facility which is called total cost to pay. So you can crunch all the rates and the fees together and it works out which one the customer will pay the least amount to over a period of time. Now that comes then into an application process where they will secure funds through a decision in principle. And most lenders then will require fairly standardised information around pay slips, accounts, bank statements, proof of ID, proof of address, etc. A pretty well trodden path that most mortgage brokers in the UK are very familiar with.
And then now we look at self-build mortgage. How is that different?
Very different, very much more specialised. Of course, the loan amount needs to be correct. It has all the usual things along with a mortgage. But beyond that, then the process becomes far more detailed and there's a far greater level of information required, particularly around the construction element of the project. So we talk about, the 3 C's, which are your construction method, the cost of the project, and the cash flow. And the latter of those is without a single doubt the most important part of the advice process for an advisor, because that's what delivers the money on site to pay people on time. That's what keeps the money coming on site to progress the build. And whilst the loan amount that's correct on a standard purchase allows you to buy a house, the right loan amount will not complete a build if the cash flow isn't correct. You've got contractors, manufacturers, off-site manufacturers who need paid in a certain style at a certain time. And of course, the last thing that anyone would want is a client to be in a position where they fall in default and can't make any contractual payments to their builders or contractors. So from the cash flow point of view, that's really important around selecting the right product to deliver that. We need to focus on the construction costs. Those costs, first of all, need to be responsible. And there are many occasions where clients can be cautious with their build costs, hoping to do works themselves. And of course, we've just gone through the last 24 months, which have been fairly unprecedented in terms of the escalation of build costs and materials that there have been in the UK. So contingency is obviously important to try and cushion some of those changes. And it's understanding all of the costs, not part of them. All of them is to the point where we have a practical completion certificate. This is a completely different take against buying a house. You're facilitating the completion of a building project, and that there's a level of support required not just to arrange that loan, but to hold the client's hand all the way through that journey to ensure that the project's finished. So we need to start with the end in mind, and that comes from truly understanding the build costs in detail and ensuring with those build costs being accurate, we then model them into a cash flow that ensures that the product selection brings the money on site at the right time. And some of the work that BuildStore have been doing over the last few years has completely transformed that risk of when the money arrives on site, because they have now moved to where all of their lending partners are now on a guaranteed stage payment to every stage. That's a huge change in terms of risk for the customer and the contractor alike, because everyone then knows what they're getting paid.
I hear about this sometimes, that you have your stage payments that we know can either be paid before or after the stage comes up. But when people get into trouble and they say, well, I need a bit more money just to get to the stage payment, what do they mean in that circumstance?
Yeah, so first of all, getting those build costs accurate to begin with are important, because if they've got their costs wrong at an early stage, and those costs are, I don't know what the right word would be, amateur in how they've been collated and delivered, they need to be very accurate. You know, a set of foundations could be £30,000, and if you tilt the site up slightly in terms of sloping and you've got to start cutting in, that could easily escalate to £50,000, £60,000 on a more complicated, less than flat site. So the costs need to be accurate, and actually the safety nets that BuildStore have built into the process over the years, one of those early stages is that the client's plans and drawings are given to a team of independent build specialists who will do a takeoff of the costings on every single case, so that those are checked to be responsible. So those irresponsible build costs, I suppose, we are able to go back to the client to say, these appear to be light, could you please explain? It may be they've already got materials on site. You know, it's about accuracy. What then happens, if I take you to the example of how the market originally was formed, which is a model called valuation-based in arrears. Valuation-based in arrears does what it says on the tin, and you've highlighted as much, that the customer pays for the stage to be completed, and a Chartered Institute valuer will be sent out by the lender, who will take a view on whether the site value has increased based on that stage of the works. Now, it's not untypical. In fact, it's pretty common that even a £40,000-50,000 investment into the ground will not change the plot value, because we're still not out of the ground yet. And there is the unfortunate misconception that the client thinks, I'm now due money back because I've finished that stage. It's an arrears stage payment mortgage. No, it's an arrears stage payment mortgage based on value. And if the value doesn't change, then they do not receive funds back, or they may only receive a proportionate amount of funds back. That's where the lender, you hear it on TV, the lender's not giving them any more money. It's often not that there's not more money to get. It's that the value of the site isn't increasing with the spend. Now, that, of course, is a risk that's too much for many. It's a product that does actually work in instances. We use it, but we only use it when we know that the client has sufficient funds, or we can release money from the land on day one in instances that will drive the build project forward beyond the point where we have any doubt that an increase in value is going to cause us a problem. You know, I've seen an interesting one recently with the client. Client had spent just short of £300,000, and the valuer was of the opinion the site had only increased by £100,000. That's a £200,000 hole in cash flow. Therein lies some of the challenges from an advice perspective. You know, a specialist in this area will look at those build costs in detail, and they will model the cash flow to see whether that model is suitable. And if it's not, there's alternative solutions. And you'd mentioned whether you get the money at the beginning of each stage. There's actually another, so the three main models, there's after each stage based on value, but there's a model that completely transforms the risk profile, which is after each stage based on cost. So if I've spent £50,000, there isn't an interim inspection by a valuer where the trigger and the release of funds is based on the valuer's comments and view. The client simply gets the money back based on the stage costs that were agreed. So it's a guaranteed stage payment when the stage is finished. And you're right, there is that advance model, which puts the money in the bank account before the stage even starts. Now, that works well for people who want to pay their contractor on a more regular basis. So rather than milestones, they might want to pay them on a weekly or a bi-weekly basis. It works extraordinarily well when, like many self-build customers, will embrace off-site manufacturing with the objective of the client and often the architect to reduce the carbon footprint of the property. And to do so, many will be using timber frames, structural insulated panels, insulated concrete form, oak, and a hybrid of SIPs. There is something quite unique about that in that you have to pay for it before it leaves the factory, which front-end loads the cash flow. And the advanced stage payment, the accelerator mortgage as it's known, delivers the money into the customer's bank account prior to the beginning of each stage, which allows them to pay for their superstructure in a timely fashion. And it's a complete mitigator of risk, again, in terms of not understanding what you would get at each stage. You know exactly what you're getting at each stage.
So just asking a quick question, you mentioned the valuation route versus the cost, the money that you put into the project. That's something you've got to decide at the beginning or something you're going to advise us on?
That's the advisor's responsibility to understand the client's project, to understand their cash flow needs, to understand the system they're using in terms of the payment terms, and ensuring that the client's selecting a product style that guarantees the customer their stage payments without fear of running out of funds at any stage. And actually, what is important, Ben, is we're talking about self-build. There's stage payment mortgages that are used for self-build, but there are also stage payment mortgages that will fund barn conversions, property extensions, property renovations. And in those last three project types, what often will happen to the project in the early stages is they will go down in value. Because if I've bought an old barn and I have to take the roof off it and knock holes in it to create new openings, suddenly something's dropping in value. If I'm adding a large wraparound extension to my home, I can use the same stage payment mortgages. But of course, what at some point I'll do is I'll join into the roof, so there'll be an opening of the roof. I'll create openings in the walls to create an extended area. My property that could be worth 300,000 could drop to 150 in value because it's no longer even wind and watertight. As a result, the valuation-based model can be problematic because if you're dependent on an increase in value to get money when the project's decreasing, it's clearly unsuitable. And of course, the loan amount might be large enough to ultimately complete a project, but unless the money arrives on site at the right time, the customer, the lender, and the building contractors and those that are all expecting to be paid have got a problem.
Cash flow is definitely one of those things, isn't it?
Yeah,
you've got to get sorted.
It's what keeps the customer in control. And valuation-based model, as I highlighted, does have a place. But in many ways, I suppose it's like asking your building contractor, how much do I have to pay you at each stage? If my building contractor says, I'll let you know when I get there, that's a bit uncertain for me. I like to know what my build costs are at the start of the project. I like to know that what I have to pay and when I have to pay it. The valuation-based model in arrears, of course, opens that opportunity for you not to receive what you're expecting because they can't tell you what you're going to get at each stage until you get there.
Now, just while we're on this valuation, could you give us a couple of examples? You've already done this in a way, but you've said the ground, we can pour loads and loads of money into the ground and that wouldn't increase value. What are we talking about? Are there very specific milestones like getting watertight? Would that be considered one? Or you tell me.
Well, there are milestones, but the absolute reality is you do not know when it changes in value by what percentage at any point. You only find out when the valuer comes out. And that can be subjective based on the valuer's comments on that day. If you're using a basement system, is another great example. You could put £100,000 under the ground. Does it change the value? Because you still don't have any walls yet. And certainly renovations, conversions, property extensions, all have that opportunity to reduce in value where there is no certainty at the point where they will increase in value. I've been doing this for an awful lot of years, and there's at no point would I try and give the customer any indication when I think the value will change, because the reality is we do not know until the valuation is completed, and that creates uncertainty.
And this valuer, I mean, this is their job to go onto sites and value, or do they do other things?
Yes, it is. Yes, it is. It's a chartered institute valuer who will be instructed by the lender. You will have a valuer goes out at the beginning of any project when a client buys a plot or a project or arranges the finance for the first time on their plot. And they will tell us what the site value is on day one. They'll tell us what the end value will be based on the plans and drawings. And they'll provide us with the reinstatement value. That's quite an important one for insurance purposes. But that's all we know at the beginning. And then, of course, we get into the construction process and we await interim inspections at the various stages of the build. And, I heard recently an expert saying, well, if it doesn't go up in value, I could ask the valuer to come out next week again. Really? another cost of another £150 for no certainty that the value is going to go up. And the reality is there is an advice process where true specialists will understand what model works best for the customer. And there is two of them are cost-based, one in arrears and one in advance, which delivers a complete risk-averse solution to it.
And some of this is in our interests as well. For example, one question that I was going to ask a bit earlier on, but perhaps I chickened out, was why don't you just give us all the money at the beginning?
That's a really good question. And in fact, you can get most of the money at the beginning in instances. If I own a site worth $1 million and I only need 300,000, I could technically draw the 300,000 out very early in the process. However, the financial reality of that is the two parts. The lender wants to see that the build's progressing. So giving you all the money and not really knowing what's happening isn't great. But there's a financial reason why you wouldn't, because BuildStore's product design team have spent many years evolving solutions for the sector and the customers to ensure that they get a real fair deal and mitigating risk, things like cost-based lending and advanced stage payments. But one of those changes to product, of course, was the ability to have your interest payments on an interest-only basis during the purchase and construction phase, and the ability to only pay for it as you take it. So if I've got a build project that's going to take me 14 months, I don't want to take £300,000 in day one and service that debt. I'd rather take £30,000 for my foundations in day one and make an interest-only payment in £30,000. I would financially disadvantage the client by taking it all in day one quite considerably. Cash flow isn't 5 stages of 20%. Every single project, we tailor the cash flow specifically to exactly what that client needs. And a good example, if my build's 500,000 and I need 200,000 to finish it, I might take 20,000 on day one because I'm going to make an interest-only payment in 20,000. Then I can use my own funds, knowing at the point when I might come back at wind and watertight, my mortgage is live and I'm just simply taking my next drawdown rather than waiting, as some customers do, till they get to that point and hope that they can get a mortgage in place. Set the mortgage in place right at the start. Again, mitigate and control your risks.
And I think sounds like the natural point then to ask about, I've got my own money, but what are some of the advantages then? So you've almost said one there of if we get things going, so we can then change how much we borrow, or again, does this go back to the beginning that we needed to have sorted that out?
Yeah, model the cash flow at the start, ensuring that cash flow is getting delivered. If the client's got enough to put the foundations in, they may choose to do so. They may have enough to pay the manufacturer. They may have enough to get to wind and watertight. Therefore, the first drawdown would be first fix. That might be 12 months down the line. I'm a bit more risk averse than that. I would rather probably take a small drawdown at the very beginning, making my mortgage live, then use my funds knowing that I have a live mortgage that I then don't have any concerns about, trying to get one at the right time. Some clients prefer to take drawdowns earlier and hold their cash back to further down where there's big ticket items. The project itself will dictate what the customer needs, and their contractor can often dictate when payment terms take place. It's about deciding when the client puts the cash in to mitigate the total cost. Don't draw lots of funds down at the start where you're making a higher mortgage payment when you've got funds to use. No two clients will see it the same way. So it's about tailoring the cash flow specifically to what the project needs and what suits the customer.
One situation that I have witnessed where people have run out of money and it's been very serious was they'd actually got a fair way through. I've no idea how they financed it on that side, but then someone lost a job. So if that happens during the process, I think this one might, part of the challenge might have been that they were looking to get a mortgage late on. What would happen if the mortgage was already live and going?
Well, the mortgage is live and going. It's the funds are there to draw down. I spoke about the ability to look after a client till the build's completed. It's not about arranging the loan. Thanks very much. Good luck with your build. We have a process that effectively we manage the whole stage release all the way through the journey for the lenders and the customer. So we're engaged with the client almost every month. We have a customer service team that speaks to our customers every month to see how their build's progressing. Are you on time? Are you in budget? When's your next stage release required? So if there's a change in circumstances, then the client has the ability to speak to us about that. It brings into, I've mentioned the phrase safety nets. Probably one of the biggest safety nets is how we protect a customer against a change in circumstances. You mentioned redundancy. It might not be redundancy. It might be a critical illness. It could be even worse as a bereavement. So there are two safety nets under the project, which is site insurance during construction and a 10-year structural warranty, which goes live on completion. It inspects the build all the way through and gives you 10-year insurance afterwards. There is every bit as big, and perhaps even more so, the need for personal insurance, which should and could include redundancy cover, critical illness, life insurance, protecting the family, because this isn't a transactional thing. This is someone aspiring to build often the dream final home. I don't want to see my circumstances changing or my family's circumstances changing, where if I'm not there to support my income, that the project couldn't continue, and that can get looked after, Ben, through proper protection planning for the customer, not just the customer, but the project. The fact that we engage with the client regularly, obviously we would be speaking to them if there's been a change in circumstances to help them, guide them and support them, and it gives them the ability to engage with the lender as well. It's always important that the client can afford to pay their mortgage. And if there is a problem coming down the line, then speaking to us early about it's really is critical.
Yeah, when you say it, it makes it all sound obvious. This is the challenge, that so much information at the beginning of the project, and sometimes you're down the road before you're doing all these sensible things. Of course, you're going to want insurance for things like that. It does make sense when you say it.
Yeah, there's too often circumstances, particularly around cash buyers, who perhaps think that they can finish it without borrowing, and then over the last 2 years, of course, out with probably what anyone could have foreseen, that there's been an increase in costs and increase in professional costs, materials, supply has been difficult, and they may have needed some funds to complete a project, only to discover that as a cash builder, they didn't put a 10-year structural warranty in place. Now, it can in instances be done retrospectively, but it'll be more expensive. Or they do it and then have to remortgage in the future, only to discover they didn't put a 10-year warranty in place, and it needs that warranty in the first 10 years to make it mortgageable. So back to early engagement with true industry professionals who this is what we do every day. And even if it's a cash buyer, make sure that the project and themselves are properly insured. And often the borrowing might be relatively short term, because they might then sell their current home and clear the mortgage off. But they still need protecting during it, because there's their current home and there's a construction project. And it's important that both are then protected.
Now, we've talked about that stage perhaps where we're ready to move in. What happens to the mortgage then? And what's happening is changing, isn't it? We talked about cash flow, and now it's different.
Yeah. So obviously towards the end of the build, the cost should be a wee bit more certain. There will have been the warranty provider coming out at each stage. They in fact sign the paperwork to trigger the stage release. And our customer service team, who have been holding the client's hand probably for 6 to 18 months, will know that they're approaching that process because they'll have been managing their stage releases for them. And they have a couple of options. So I spoke about our product design team, and I think it's only fair that they get a true credit here in terms of how flexible they've created our partner lender solutions, because we have that interest-only concession during construction. They're on the self-build interest rate, paying for it gradually as in stages. But then we get towards the end of the build, and we do have products that are designed with no early repayment charges, which can be particularly helpful for someone who's then selling the previous home and has an ability to redeem the mortgage or a significant amount of it. But we also feel that it's not treating the customer fairly to have them on the self-build mortgage any longer than the period where it's a self-build project. So on receipt of their completion certificate, then all of our lenders and products have a free switch facility. So they'll get to select a residential high street product from the lender, and either they can maintain an interest-only basis if they have an appropriate repayment vehicle. Most will then switch to repayment on a standard residential mortgage from the lender. So they move away from the self-build product as soon as they have the build completion certificate. And I think that's really treating customers fairly, where you have that, I suppose, almost a temporary product, the self-build product, and then you revert to the longer term, could be a 2, 3, 5 fixed rate product, whatever suits the customer at that point. And that's where that ability to, as an independent mortgage specialist, to provide the client the then ongoing mortgage requirements for the remainder of their mortgage life is really important.
Yeah, it's like you've done this before. You've got the whole journey mapped out.
just the 30,000 or so. But we never sit on our laurels. It's about ensuring that the lenders that we partner with and our products really fit the needs of the customer. And in many ways, it's about opening up the sector. I suppose watching the TV programmes doesn't really dispel any of the myths, but it appears to be for the third and fourth time house mover, well-heeled, empty nesters, because there was always a need for people to own land or have significant deposits. Well, we've now got products at 95% of the purchase price of the project or land, and up to 95% of the build costs. So as a first-time buyer with a 5% deposit, why should I be railroaded into a volume house builder solution when I could be involved in the design process of my own home? People would prefer to have more design choice. Well, they can, because there are now products with small deposits that allow you to commission your own house build rather than buy a house.
And I know that you've been quite involved in custom build as it's come about. Yeah. So again, is this another product we're talking about here? How does that change things?
Yeah, it changes it in a few ways. It again has a spectrum, I suppose, from an enabler perhaps putting in the roads and services, and you can then buy a service plot as part of a small, medium-sized development. And you're it almost creates a mini community of like-minded people. But equally can be developer-led, where a developer might have house types that are customizable. I've seen the models called like a blank canvas, where you have a input to the design on the internal layout of the house, and there's a contractor involved. So there's a variety of delivery methods for this. And not all of the self-build lenders lend on custom build, because there's the associated risk of the other plots around it. And as it's often more of a developer-led proposition, more contractual than DIY, then our design team, product design team, again went into overdrive and created custom build mortgages which are bespoke for that particular sector. And that certainly is a cost-based solution, because you can't have a situation where a contractor wants paid and we're at the mercy of the valuer whether we'll have an ability to do that or not. So the cost-based model certainly sits right into the heart of custom build. And if that custom build developer enabler is working with an offsite manufacturer, like a timber frame company, the advanced stage payment model becomes, again, pretty critical to ensure that the customer can make the payment terms. Actually, what does happen in reality is we prepare a panel of lenders for every development that we partner on, because the lender wants to know what's around them. This isn't a one plot, is it? There is a customer and a plot. The rest of the site, they need to manage their concentration levels. So if this was a volume house builder site of 200, there'd be 5 or 6 big high street lenders taking up to 20% each on the site. On custom build, it's regional building societies that provide the self and custom build solutions. And those regional building societies, again, need to manage their concentration levels on every development. So what we do is we work with the developer enabler. We provide the lender and the valuer with a significant amount of information so they can fully understand the project, and they will advise us how many plots they will take on every development, and we can then manage the distribution of that to the consumer. And there needs to be a real strategy in place to deliver that. And of course, you need to have access to sufficient lenders to enable you to do it.
Is there anything else that we should have talked about today that perhaps we've skipped over?
Ben, I think you've done this before, because the questions are very good questions and make absolute sense. I think from the consumer's perspective, I think it's really already highlighted the fact that early engagement is important. Work out the budget clearly, make sure the budget's responsible, make sure the build costs are responsible, and those can change geographically, include contingency, and ensure that they're dealing with an industry specialist. This needs to be what they do every day. I'm not going to my GP for my surgery. I'm going to go and deal with someone who knows specifically it's what they do day in, day out. Make sure that the advisor has access to all lenders and all product types. I suppose there was a major change last July, to the mortgage market called Consumer Duty. And Consumer Duty brought with it guidelines and rules for us to consider as advisors. And one of the big things that we really need to consider is that the client doesn't suffer a foreseeable harm. What's a foreseeable harm on self-build? Well, the client running out of funds is one. Client not getting funds when they think they're getting them, not receiving sufficient at each stage. Actually going to a lender where the lender perhaps doesn't lend on that particular cladding or that roofing material. It's a specialised area, and I would just encourage people to speak to industry specialists and make sure that the industry specialist has access to all lenders and all product types. And I speak as someone who's self-built my own home. In my view, I can't see where I would run the risk of having a valuer coming out at each stage to decide when I get funds if I can guarantee my stage payments.
Yeah, it does sound that the whole point of you being in at the beginning is to make sure things don't go wrong. So is that actually a fair comment? You must have seen things go wrong. I mentioned earlier, I've seen things go wrong. What is happening in those situations?
That process of us working with the client literally every month, contacting them, dealing with their stage releases. If it's going to go wrong, if I speak generally, it's going to go wrong royally, it'll go wrong in the ground. Difficult ground conditions, running sand. We do test pours on sites, but it doesn't truly give you a full site understanding of what's below the ground. So if it's going to go wrong, and if there's basements, of course, that's a greater opportunity to create more problems. And that's where more contingency might be appropriate. What happens once you're up out of the ground? Unless it's wars that caused a real ripple right across the sector in terms of build costs, it tends to be a gradual creep, Ben. And all I would say is that customers have an opportunity to not get excited and carried away and change the worktops from a traditional worktop to a granite worktop, and the flooring from being relatively inexpensive to becoming granite. And it tends to be a gradual creep. So once the customer sets off on the build project, I would just really say try and keep a strict hold on it and not be tempted to change things once you've started. The ones that I've seen that have been significant tends to be where the client has changed something. Post-planning, went back for amended planning and is building something different. One of the biggest ones, of course, is working with the architect. I think it's really important that the architect's given a clear budget to give them a fair chance of designing a house that can be built for that budget. If it's a guesstimate, the architect will do what they do best, which is bringing to life something a bit special, but all it takes is an overcomplication on design, and it can throw build costs from £2,000 a square metre to £3,000 a square metre. The volume house builders build a particular shape of house, which is repeatable, and it controls cost. I could take a 250 square metre square house and make it H-shaped and significantly increase the build costs. How do you control it? Have your budget to begin with, early in the process, and ensure that your professionals that you're working with, your architects and engineers or package providers, which we've got some great examples in the UK, have a very clear budget to work within.
Yeah, we're big fans of just scale down your ideas a little bit and do it at a higher quality.
Yeah.
Comes up a lot.
I've seen clients who have that, I've just had my house designed and budgeted and priced and it's coming out at 600,000 and I can only afford 400. What do? You make it smaller. And in hindsight, have your budget set before you design the house.
Yeah. Well, Tom, some really good information in here today. Thank you so much.
Absolute pleasure. Thank you, Ben. Take care.
Head online to take a look at the show notes that accompany this session, houseplanninghelp.com/358. We've got a summary for you there, so you can go through, just review some of this. There's a lot of information coming your way. We've also got links to BuildStore, as you might expect. Perhaps you've got a comment or you'd like to ask a question. Either do that, scroll down to the bottom of the show notes, or we'll add the social media links. And if you're one of our hub members, Tom has done a training session for us, which takes you through everything in a logical sequence, going into a bit more depth as well. And there's only so much you can do in an audio conversation as we've been having. And it's a bit more light-hearted, isn't it? So if you're ready to get into the detail, then we do that in the hub. Just click on the link, all within houseplanninghelp.com/358. Finally, today, I wanted to ask a favour, and that is to review the podcast. Wherever you're downloading, normally they give you the ability to write a review, to encourage others to listen and download, and that's what we'd like. So if you've got some value out of today's podcast, or hopefully many in our series, please pay us back by writing a review, for example, in Apple Podcasts, in their directory, or wherever you're listening. And a big thank you goes to you. Next time, Paul Morris, owner of Solar Shield Exterior Shading Solutions, is our guest, and we're looking at external shading. Why external? What does it do? How do we incorporate it in our projects? The when, the why, the how much does it cost? All of that next time. The House Planning Help podcast is produced by Regen Media, content that matters.